How do you turn your ISA into a retirement income? Okay, this is a very interesting question and something we hear a lot here at Cameron James. So when you have your ISA, let's take for example, you have £200,000 in your ISA. At age 50, you started saving £20,000 per annum. It's now age 60, and let's just assume you have £200,000 invested. You've had £100,000 worth of growth, so you have £300,000 in your ISA. Okay, you have a couple of options here. Right, you could just start drawing down the capital as retirement income. Now, we all know ISAs in the UK are free from capital gains tax. There's no tax on the growth of your assets over the course of time. So what we need to look at with that is and understand, if you just draw down, there's no harm in that. You can access your stocks and shares ISA or your cash ISA. The example I was talking about here was the stocks and shares ISA. You could just draw down your capital as and when you need it. A bit like a pension scheme now, from age 55 or 57, you have flexible access drawdown. An ISA is 100% flexible. Now, obviously the only caveat is if you have a stocks and shares ISA, for example, the AJ Bell ISA that we use here at Cameron James, you would have to obviously sell down those assets, they get to the cash account, and then you complete the withdrawal. But these things happen pretty fast in the modern age of financial services. So yes, you can just draw down and you can take as much or as little as you want. You may be saying, okay, I have 300 grand in there. We wanted to have one big all out holiday on our 60th retirement. We're going to take 10 or 20,000 pounds, whatever it is, to go and enjoy this retirement in the first year. Perhaps the second year, the third year, maybe you don't touch it. Maybe you have your other pension income or something else that you're drawing down, or property income. So you can have that model of being very, very flexible with the ISA. What's most important though is if you take a drawdown strategy on the ISA, obviously remember, anything you draw down, you can't then re-top up again. You only have £20,000 allowance per year. So really you should be drawing down your bank account and any GIA accounts first before you move on to your ISA, because your ISA is savings free from capital gains tax. GIA and bank account are not free from capital gains tax, depending upon how much you've earned in interest over the course of the year. So it's very important to look at that and not take money out of your ISA account too early if you have other funds. We typically say people should have around 6 to 12 months expenses sitting in their cash account ready as an emergency fund. Anything after that, yes, you could draw down, you could typically draw down on the ISA. The other option potentially would be to take all of the £300,000. Now, obviously you'd be getting rid of 10 years of allowance of building up your ISA account. You'd have to withdraw it all down, which then means you would have zero in ISA, and you'd have to build it up again by 20 grand, 20 grand, 20 grand. I'm assuming the UK government keeps it at 20 grand. It will probably increase over the coming years. To go and buy an annuity with that £300,000. Now, an annuity is basically what everyone used to do with their pension pots until the UK government introduced flexi access drawdown, which allow people to have more control. Now, I've said this before on the channel that I'm not the biggest fan of annuities. I think a lot of people are still in that mindset. They think they need to go and take an annuity because that's what happened before. That was what was done before. If you look at the mathematics though, you giving £300,000 to an annuity provider, you have to ask yourself, nobody works for free in financial services. If somebody is going to let you give them £300,000 and they're going to pay you a guaranteed income for life, why are they doing that? Are they doing that out of the goodness of their own heart because they're a good Samaritan? No. They're typically a FTSE company. They have shareholders, and their goal as a company is to deliver profits for their shareholders. So in that relationship, they will typically be making money on your £300,000 in comparison to what they're paying you as an annuity. Now, that's not to say annuities are bad. For some people, annuities are extremely suitable, but I prefer, generally speaking, unless a client needs a guaranteed income from life, I would recommend them to keep the money inside the ISA account and let it to continue to grow and compound and grow and compound. So that's a very quick video on potentially how you can turn an ISA into a retirement income. If you want to speak to myself or one of our advisors here at Cameron James, you know what to do. You can go to the description section below, have a very quick chat with me on WhatsApp informally, or you can book straight into the Calendly diary. When you book into the Calendly diary, feel free to include as much information as possible. Giving us information doesn't sign you up as a client. It will just allow our financial advisor to make that first 60-minute meeting with you as valuable as possible for you to get the very most out of the meeting. And also let me know in this comment section below, do you think I'm right? Do you think I'm wrong? What is your strategy with your ISA, and what are you planning to do in comparison to your pension, your ISA, your GIA, your cash account? In what order are you planning to draw them down? And as always, take care with your UK and UK pension assets.